With $80 billion added to the budget of the IRS, you can bet one thing: they are coming for you. With all of this out of control government spending, the feds desperately need to raise money to pay for it. One of the easiest ways to do it is more enforcement of the existing tax laws. The IRS believes that this funding will result in an additional $124 billion of tax revenue from audits without raising tax rates. If you're watching this video, I bet that you're a law-abiding citizen, happy to pay your fair share of taxes, but not a penny more. You probably are a successful business owner or are building a business while working your 9-to-5 job. In this video, I'm going to outline 10 keys to avoiding an IRS audit. After speaking to numerous CPAs and tax preparers over the years, I've been able to hear stories of poor behavior and best practices to make sure you aren't paying too much to Uncle Sam, but also aren't running afoul. So what do you do to make sure you aren't overpaying your taxes? Stick with me as I give you my 10 keys to avoiding an IRS audit. Hey, Colin Exelby here. I'm a certified financial planner professional with over 20 years of experience providing financial planning for business owners and their families that just makes sense. I own the financial advisory practice Celestial Wealth Management and provide advice virtually to clients all over the country. While the IRS says they can raise billions of dollars from tax cheats, I'm here to say that many people I run into actually overpay their taxes. Yes, you heard that right. Many people don't take advantage of all the deductions, credits, and strategies available to them, either because they don't know, are too scared, or they actually forget to. So I want to make sure that you're taking advantage of all the opportunities to save money on taxes that are available within the laws. The vast majority of the huge tax code explains how to take advantage of those different opportunities and how to document and account for them. If you do that, you will most likely be in a great position. But to further strive to protect yourself, here are my 10 keys to avoid an IRS audit. And this is a perfect spot before I hit those potential tax benefits to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. Number 1, surround yourself with a competent tax advisor. I can't tell you how many people I have come across who receive a letter from the IRS or are audited because they choose to do their taxes themselves. Now, in some cases, your situation may be so simple that makes sense. But even so, having another set of eyes on your return can help spot simple mistakes. In addition, a good CPA or tax preparer can help you find deductions and credits that you are entitled to and properly account for them on your tax return. This is one area where DIY can cause more problems than it's worth. Number 2, document, document, document. The IRS hates round numbers. That is a red flag. Do you own a business and buy office supplies? Did you spend $17,386.52 at Office Depot last year? Or did you spend $18,000? I doubt if you have proper tracking, you bought items that added up exactly to $18,000, and neither does the IRS. Did you have a business cell phone or mileage deduction? I doubt that deduction ended in exactly $1,000, and guess what? Neither does the IRS. Round numbers are a big red flag and a signal to the IRS that you may not be documenting properly, or worse, are not being truthful on your return. Keep good records so you aren't guessing. Number 3, understand your industry average expenses. Each person that files their tax return indicates the industry they work in or if they are retired. This helps the IRS categorize your expenses and use software to screen for abnormal expense levels compared to your income. If you have an expense that is extremely high for your industry because of some one-off scenario that happens, even if it actually happened, you may want to consider reducing it. I know, I just told you to make sure you're taking every deduction that you're entitled to, but this is one area where good judgment may overrule it. First, make sure you have all your receipts and have tracked that spending before taking a deduction for something uncommon in your business. For instance, if you are taking advantage of the current 100% deductible dining expense of potential clients and it's a large portion of the revenue of the business brought in, then maybe that will stand out to the IRS if it's out of line with industry standards. Work with your tax team to understand industry standards before taking the deduction. Number 4, provide additional comments and statements. If you have an out-of-the-norm deduction or strategy, providing additional documentation and clarity can do nothing but help. If your return is flagged and an actual agent reviews it, an agent could choose to bypass your return for an audit because you already provided the supporting documentation that the agent would be asking for in the audit. This is where a seasoned tax preparer can really help. They would know when that additional documentation may be warranted. And if you like the first 4 keys, make sure you give this video a like and smash that subscribe button. Number 5, don't delay. File your tax returns on time. The government always assumes the worst. They think if you didn't file that you were hiding something, even if you weren't. Many times money can be short, so people just don't file their returns. This is a huge no-no. File your return on time even if you don't have the funds available. There are failure to file penalties if you don't. If you don't have the funds, there are some payment plans and some other things you can do. But failure to file penalties can add up and make your life even more stressful. Number 6, don't forget to issue 1099s in January for contractors. I get an email about this from my CPA every year. Did you use any contractors we need to send a 1099 to? It's a great reminder for me. When you are claiming a business deduction for using a 1099 contractor, you better have issued the proper 1099, which must be delivered in January each year. And be sure to request the W-9 form from all your contractors before paying them so you can properly do it. Number 7, file your payroll. If you have an S-Corp as a single employee or have multiple employees, you better be running payroll. This is another red flag. If you are claiming a salary and distribution, but you don't have proper payroll set up, you are asking for an audit. Withholdings from payroll is as basic as it gets. You should never get behind or forget to send withholdings to the government on behalf of employees. And you may think because you are a single employee S-Corp that it doesn't matter as much. And you would be wrong. If you want the benefits of the S-Corp, then make sure you submit your payroll. The easiest thing to do is to have a payroll service like my favorite, Gusto, or QuickBooks, Paychex, or even ADP. End of story. Number 8, don't forget retirement plan contributions or distributions. Each year, people are audited for failure to take the required minimum distributions from the IRAs or 401k retirement plans. Many people have multiple IRAs and 401ks and may even forget about them because of poor organization. Once you reach age 72, you are required to take money out of these plans each year. Failure to do so results in a 50% penalty on the amount that should have been taken. That could be huge bucks. If you did forget, get it taken care of as soon as possible. Secondly, if you put money into a retirement plan for yourself or for your employees and took a deduction, make sure you have the records to prove you in fact did it. Number 9, in my opinion, try to avoid the sole proprietorship if possible. Having a small business or a side gig is a great way to increase your net worth and potentially lower your taxes, but reporting it as a sole proprietorship can significantly increase your chances of an audit. Why? Again, the IRS looks at the worst case scenario. They think if you haven't set up the structure of a corporate entity, you may not be taking the business seriously, or worse, they may say it's a hobby. If the business as a sole proprietorship consistently loses money, the IRS could easily say it's a hobby, not a business, and disallow your deductions. According to an article from PrimePay, in a study conducted by the National Taxpayer Advocate, an independent office within the IRS, the possibility of an audit is higher for a sole proprietorship who receives their revenues in cash. This is also more likely if you live in an upper-class suburb because the IRS seeks out those it thinks will have the income to pay owed taxes. Auditing prosperous sole proprietors who just might have underreported their taxable earnings would be a good place for an agent to start. So, if you're a sole proprietor and you live in New Carrollton, Maryland, College Park, Georgia, Beverly Hills, California, and Newport Beach, California, make sure you and your accountant report accurately. The studies show that these towns are home to well-off Americans who also happen to be sole proprietors and possibly maybe more prone to underreport earnings. According to the IRS, construction company owners, which typically are cash businesses, and real estate rental firms also tend to underreport. Lastly, number 10, if you get an IRS notice, don't ignore it. It will not go away. Remember, the IRS expects the worst, so ignoring them is a big red flag. Notify your tax preparer right away if you receive a notice. The letter may or may not be serious. Sometimes there's a simple request for clarification that can help you avoid an audit, but if you ignore it, you're asking for an audit. Here is the bottom line. I will say it again. Document, document, document. It will save your butt. Keep good records and take deductions and credits you are entitled to. Pursue tax strategies that have been vetted and have court case decisions in favor of them, but also file your returns on time. Finally, don't stick out. Finding the needle in the haystack is much easier if that needle is bright pink. I hope you enjoyed this video with my 10 keys to avoiding an IRS audit. Do you have more? I would love to hear about them in the comments. And make sure to watch these videos next to have your financial planning supercharge your life. Get clear, be clear.